My name is Patty Hasson. I'm the Executive Director and President of Clarifi. I had the very difficult job of following President Harker and Governor Brainerd with the first panel. I'm confident we can all agree they both set the tone for what will be very engaging, thought-provoking 2 days on extremely relevant topics of fintechs and the new financial landscape. For those who don't know Clarifi, we're a Philadelphia-based nonprofit that's been providing one-on-one financial counseling and group education for over 52 years. We operate in about 15 locations in 3 states. About 92% of the clients we serve are considered low to moderate income. And given our regional footprint, we've built up a strong level of trust in this community, and more importantly, with past and present clients. This panel is of particular interest to me because fintech companies are often approaching Clarifi to understand and serve our clients. We have 4 esteemed panelists today, all CEOs, that are on the forefront of the fintech movement, using AI to develop loan products and credit cards that could benefit many of the clients Clarifi serves. I'm not going to read each of their bios since you have them in your program. I encourage you to read their bios because they're all impressive entrepreneurs, and in some cases, serial entrepreneurs, who have raised substantial dollars from VCs, investment banks, and impact investors, and have already collectively originated close to $20 billion in loan originations in a few short years. Each panelist is going to do a short presentation, followed by some moderated Q&A to allow discussion among the panelists. I'd ask that you hold your questions until the end, where we will allow time for Q&A. So our first panelist that will be up is Al Goldstein from Avant, CEO. Thank you.
Thank you, Patricia. I guess I get the honor of trying to figure out how to actually get my presentation up here.
Click on your name.
All right. Magic. So I'll be brief just to give you a little bit of an overview of what we do at Avant. And I was joking that I have the longest title now because we effectively have 2 companies under one roof. And so we have a company, Avant, and I'll just flip forward a little bit, which is where we started 6 years ago with the simple idea, albeit somewhat of a daunting one, to build the digital bank, and I have it in quotes because we're not a bank, for the middle-income consumer segment. And we define the middle-income consumer segment in the U.S. as the 40% of the American households and populations with household incomes between $40,000 and $100,000. We view them as being underserved by the traditional banking community, but we believe that we could serve them with products that are efficient, that are transparent, at rates and at a cost that they're going to find to be useful. And we started with the unsecured personal loan product, of which we've originated at this point over 800,000, nearly $5.5 billion, actually nearly $6 billion now, originated on the platform in that product. We launched our credit card offering, which is called the Avant card, in partnership with WebBank as our bank origination partner about 1.5 years ago. We've now originated over 50,000 cards. We plan to scale that business and ultimately plan on providing a full-service banking experience, including savings accounts, personal financial management tools, and additional products to consumers. Separately from that, about 3 years ago, we launched Amount, which is in the business of empowering very large financial institutions with the same technology and analytical horsepower and tools that we build for ourselves. And to date, we've announced partnerships with some very large banking institutions, including HSBC, which was announced at Money 2020, the big industry conference in financial services, a few weeks ago. And I'll talk about that in a little more detail shortly. We have an unbelievable team that's been together for a long time with diverse experiences from large banks like HSBC and Household Finance, from technology companies, and that allows us to actually be successful in this world, what you call fintech, the combination of experience both from technology and financial services. And we have a board of directors that's phenomenal, that includes industry practitioners and operators from the likes of TransUnion, from American Express, entrepreneurs, former regulators like Jan Eberly that joined us recently, who's phenomenal, and some great investors that support our vision. We've raised $600 million of equity capital to support what Avant and Amount are trying to do, and those investors are phenomenal. We are performing, we have scaled, our business Avant is now profitable, is growing at 40% a year. Our Amount business, which is the technology company, is still relatively small, albeit it's growing at nearly 80% a year. And we're very excited about the fact that we've now reached profitability as a business, which for those that follow startups, they know it's an elusive target sometimes. So a little more on Avant. We try to provide really clean, transparent products using AI, and I'll talk a little bit more about that as we get further along, and I think Governor Brainerd did a wonderful job of laying out some of the benefits and some of the challenges. But we really aim on providing a unified experience to our consumers. The goal is pretty simple, I have 3 little kids. We don't go to the store for anything. We have way too many boxes that show up at our house. We may need some AI to help us figure out what to do with those boxes. But if we want something, we go on our phone, we buy it. The goal of what Avant is trying to do is make the financial services experience for those middle-income consumers the same. Make it simple, clean, transparent, provide them great products that they're happy with. And we do that. We have a simple and transparent application process. We have really high net promoter scores. They're in the 80s. They rival that of Amazon. And we allow consumers to manage their day-to-day financial lives in a clean, transparent way. And because we have the combination of multiple products, our credit card product, our personal loan unsecured product, and our partnerships with banks through the Amount platform, we actually are able to provide a full-service experience across the credit spectrum, whether your credit score, FICO score, may be 550, 600, or whether it may be 800, 850. The key is we want to provide you the product that fits your day-to-day need. On the Amount side, this is probably hard to see, but in the wheel, really there are multiple components of what we try to do. On the top, it's the products. And today, our partnerships are really focused on the personal loan product, but very quickly we're expanding across the landscape of products that the banks provide and really helping them digitize those product offerings for today's need, for the consumers or small businesses that demand a better level of service. And below, you have modules. These are components that are potentially relevant to each product. So verification, credit decisioning using AI. It's the branch integration with an online offering. And we also provide capability and professional services because very large banks sometimes may not have the right capability in machine learning, in AI, in digital marketing to actually affect change. And so we provide that capability to them when they need it. Our long-term goals are to really expand our capability over time. Today, our partners are really the largest banking institutions. Really, we've been spending our time focused on really customized technology solutions for the top 50 banking institutions. Our goals are, though, to create configurable products for the broad range of banks, really serving the top 1,000 banking institutions, and over time really build full core banking capability. Because I think a big issue that our bank partners have is their legacy technology stacks that prevent them from actually building efficient products. Just a little more detail, one of our modules that we provide is what we call Amount Verify, which allows banks to not only battle credit online, which historically, when banks have tried to offer credit online, they've always had high losses and they've pulled back. And one of the issues is those losses are a combination of fraud and credit. And historically, the banks have not been able to bifurcate those two. We allow them to do that with what we call this Amount Verify product, which encapsulates verification and fraud and helps them separate that from the actual credit decisions that they need to make. And we integrate lots of third-party tools. We give them a framework to actually be effective at online origination. The Amount Score is a specific score tailored to fraud that banks can buy, which uses machine learning technology to really bifurcate that and focus on that potential fraud of a given customer. And we've been very, very effective. Some of our banks have fraud losses that are 100, 200 basis points in their credit card products. We help them bring those losses down to 10, 20 basis points. In turn, that allows them to actually provide great products to the customers that are legitimate customers on their platforms. One other thing just to touch on, a company by the name of Spring Labs that we founded within Avant about 1.5 years ago and actually spun out, so it's now a completely independent company. Avant is a strategic partner. It has some relevance, though, and I'll touch on some of the comments that Governor Brainerd made around credit bureaus and some of the issues with credit scores today. We've built an unbelievable team. At this company, it's got some world-class advisors. Most recently, Gary Cohn actually joined as an advisor to this company, but we have Sheila Baer is an advisor to Spring Labs, Bobby Mehta, former chairman, CEO of TransUnion, Nigel Morris, former co-founder of Capital One. So we have this amazing group of people, and what is it that they're trying to do? They're trying to build a blockchain-based, decentralized credit and identity network, because the existing ecosystem has extremely high cost. It's got security risks, as we've seen with hacks at places like Equifax, and it's got inaccuracies in consumer information. And so what Spring is trying to build is a triple-blind network where the individual participants, the individual owners of data, can communicate directly with one another in a very secure way without giving up the data that they cherish for security reasons, for competitive reasons. And one of the potential long-term windfalls is creating an ecosystem that is self-correcting. So when there is incorrect data, incorrect information, it actually corrects itself over time because the different participants in the network figure out, okay, this is the right answer, so let us weed out the synthetic fraud. Let us weed out the inaccuracies in consumer credit profiles. And the way to power the network is with a token that actually, for the first time, would allow the individual participants to derive value from the data that they possess, and so create economic incentives for accuracy. And hopefully, over time, actually get more data into the whole credit and identity ecosystem, which in turn allows models to be more predictive, which in turn, hopefully, will pass on savings to consumers and businesses. So that was a lot in a short period of time. Thank you very much.
Hello, I'm Jeffrey Meiler, CEO and founder of Marlette Funding. Let's see if I can bring my presentation up.
You just click the next, click to the right.
Al, did you do this deliberately?
Yeah, definitely. Thank you.
Nope, I'm not getting there. That's okay.
Yeah. Close his first.
Thank you.
No problem. And then Jeffrey.
Yep, that's the guy.
There.
Okay. So it's going to be my pleasure to not only introduce you to our platform, I'm going to introduce an opportunity that you can actually help with. And that opportunity is to reach more invisible prime. So the first part is to introduce you to our platform. And we're almost 5 years old at this point. With the support of our bank partner, Cross River Bank, we launched 5 years ago our online platform to digitally deliver personal loans in a simple, easy, fast way. Our platform, the function of it, is really to address the gap that was created by the Great Recession and the retreat of people's branch networks. We are based in Wilmington, Delaware, with a small team out on the West Coast. Why have a West Coast office? Well, that's where you find the best decision science people. We are a team of, similar to Al, a seasoned group of banking professionals with deep experience in consumer lending. And we're looking to similarly apply technology tools and new and innovative ways. We are very well versed in consumer banking regulation, and our focus since the start of the company has been on internal controls and the development of our compliance management system. To date, in a little over 4.5 years, we have originated $6.7 billion in unsecured consumer personal loans. As a technology platform, similar to Al, we provide comprehensive services to our bank partner. That's inclusive of marketing, that's inclusive of underwriting, technology, account servicing, capital market support. CRB, our bank partner, is a state-chartered entity and a leader in the intersection of financial services and technology. Mechanically, how we work with CRB establishes the credit policy, then reviews, approves, and originates our loans, and retains a significant portion of the loans. And as you might expect, CRB oversees all aspects of the program, auditing different aspects on a virtually constant basis. The platform and the product we have is called Best Egg. We provide a risk-free, simple process for consumers to see if they qualify for a loan offer without impacting their credit score. Applicants receive funds very rapidly. We transmit funds to greater than 50% of the consumers within 24 hours of them applying and accepting their loan. Application process is 9 to 11 minutes. Historically, from a product standpoint, we've offered 3 and 5 year terms, and now are experimenting with terms that span from 2 to 7 years. Our technology stack is really a huge enabler for us, and it leverages all the advantages of being new. And we've talked about some of these already today. The ability to have no tech debt, Al referenced. We can rapidly deploy new technology because it's AWS-based and cloud-based. And as you'd expect, having a totally new infrastructure, you have the ability on the front end to invest upfront in your cyber and other control processes before you build out the infrastructure. Now, from a borrower standpoint, we today serve prime consumers. Defined here, as you see on this page, FICO 640. Home ownership is 70%, and these consumers tend to have thick credit files. Today, we do not serve thin files or no credit files, but that's the opportunity I need your help on. Most consumers that take out our loans do it for the reason of consolidating credit card debt or debt consolidations. And they generally, as I said, have mature, thick credit histories, reliable sources of income, and by our best estimation, they're able to repay the loan. We reach a range of consumers, identifying and serving some credit invisibles. So as you know, there are at least 3 flavors of credit invisibles. There's new to credit, there's exited the credit system, and the third is the banking desert population. And that's the population that we serve today in the credit invisible world. Banking deserts, as you know, are locations where there are few or no bank branches. New to credit and exited credit are categories of consumers we do not serve today, given the importance to us of a bureau file and the absence of clear permission to access alternative data to underwrite them. There we go. We leverage today the voice of the customer to guide all of the development of products and services and understand how we are delivering our brand promises across customer contact channels. And we use all kinds of tools and technology to do this. Most importantly, in the context of this forum, we use next generation AI tools to automatically analyze open-ended feedback at scale. Specifically, what this enables is us to measure customer sentiment and customer satisfaction at the agent level. So at the customer service agent level, what are they achieving from a customer satisfaction standpoint? Verification and inbound telemarketing, same thing. Our customers appreciate the speed, ease, and convenience of our process. And similar to Al, we have proof points that are robust. A net promoter score, not of 80 like Al's, but 85. At 12 months on book, 85% of the consumers would choose Best Egg again. 90% of consumers fully satisfied with the resolution of their issue that they called in from a customer service standpoint. So how do we, and I'm going the wrong way again, sorry. How do we use data and AI? We are able to collect an enormous amount of data, and hence we have this robust cybersecurity program that I mentioned. Data analytics, and I'm going to get there. Data analytics is an important and growing function for us. In underwriting, we work with credit data and application information. Third-party lending reviews are a part of our and CRB's compliance program. And as mentioned in the opening remarks, of course, both parties use third parties to also do fair lending reviews. We have a data lake that has over 30 billion data events. We capture customer data that includes the traditional attributes you would think of when you screen for credit, inclusive of application information and credit scores and many other data elements. Specifically, if you focus in on the upper right hand part of this PowerPoint page, we capture over 1,500 credit elements that we use to create proprietary attributes which greatly enhance our ability to predict repayment and help to establish responsible loan amounts and related pricing. In addition to that, before we transmit funds to consumers, we're tapping over a dozen different data providers who give us over 1,000 data elements that we use to run fraud strategies, regulatory checks, and to verify the accuracy of the information the customer provided. We use data science and machine learning, natural language processing, and text analytics to do the following things: predict and anticipate consumer behavior, make optimal recommendations and offers, create an optimal customer service experience, and evolve product features and benefits. But we are actively exploring not only using machine learning and fraud, which Al referenced, but how we can use it from a marketing and operations standpoint. But a key element of our success is not just the technology that enables us to capture and store and connect all this data. A key enabler for these platforms like ours or Avants is our ability to easily and quickly plug into different data sources using an API protocol. So what's the potential here for Marlette? We have an opportunity to serve more of the invisible prime consumers. We have a highly malleable platform that is able to reach these consumers. We have tools and sophistication to create underwriting models to extend credit responsibly to those that can repay. The opportunity is the key in the middle, alternative data. The opening of the session was focused totally on AI, and that is an incremental opportunity. But step one is the use of alternative data. For these people that don't have a lot of credit information or have exited the traditional credit path. Examples of the types of data that would be really, really useful are inclusive of the following. From a financial and wealth standpoint, what level of assets do consumers have? What's their net worth? What level of equity do they have? What loan to value do they have? Have they paid taxes? How much? Do they have cars? What is the number of cars they have? What's the brand? What's the age? From a cash flow perspective, that's pretty intuitive. From a non-credit financial behavior standpoint, what are their rental payments? What are their utility payments? What are their telco payments? From a lifestyle standpoint and a background standpoint, we'd love to know from an academic and ability to use standpoint, school, degree, GPA, major. From an occupation level, how about whether they're an executive, whether they're a senior manager, whether they're a middle manager? From an industry perspective, are they tech, are they fin, are they auto? From a life stage standpoint, are they empty nester, full house, number of dependents? Digitally, the digital footprint is highly predictive, and there's at least two flavors of opportunity there. There's device tracking. What places have these consumers visited? From a web behavior standpoint, what's typing speed? What's typing accuracy? How fast are they scrolling through disclosures? From a social profile standpoint, likes, what topics are they engaging with? This is information that's highly predictive. And if not used in the context of AI, you don't have the explainability challenge. Huge potential. Given keen regulatory scrutiny of fair lending compliance, we, like many others, are cautious, though, in our approach to use alternative data like this. The no action letter that the CFPB provided to Upstart is a hopeful and encouraging sign that regulators will find an opportunity to encourage greater use of this data, perhaps even creating additional safe harbors for study. We, would support collaboration and joint efforts to create a sandbox or find other ways to permit safe, responsible use of alternative data. Thank you very much. And Ken Ross will be next to try and figure out how to work this clicker.
Good morning, everyone. Look at that. Great. All right, I'm Ken Rees. I'm the CEO of Elevate. We are a fintech company focused uniquely and exclusively on the needs of non-prime consumers, both in the US and the UK. We've served now over 2 million consumers, originated over $6 billion of credit, and along the way have saved customers billions over what they would have spent on products like payday loans. We have 4 products in the market today, 3 in the US, 1 in the UK. In the US, we have an installment loan product called Rees, a line of credit product called Elastic, and a credit card that was recently launched called the Today Card. All, again, focused on the needs of non-prime consumers, with rates that go down over time, very consumer-friendly features helping consumers rebuild their credit, and no fees and things like that. Why are we focused on the needs of non-prime consumers? Because that's really what the U.S. is now. The U.S. is a non-prime nation defined by lack of savings and income volatility. In particular, 40% of the U.S. with less than $400 in savings. Add that to the 40% of U.S. that has income volatility. This is according to, I think U.S. Bank came up with this statistic, that 40% of their account holders had 30% monthly income swings. You add lack of savings to income volatility of a recipe for financial stress, and that's really what you're seeing in the last pie chart, which is now 2/3 of the U.S. with either a non-prime credit score less than 700 or no credit score at all, the credit invisibles. This is a big problem, and the majority of fintech innovation still has been largely focused on that small sliver of prime. What we're trying to do, and a lot of the people on the stage is trying to do, is find a way to use fintech technology, fintech analytics, to better serve these non-prime, deeply underserved consumers. And part of the problem is the banks have pulled back. We set up a research organization we call the Center for the New Middle Class to look into the unique needs of non-prime consumers versus prime. And the differences are stark. If you're prime, 90% of prime consumers that we surveyed think that they would get a credit card or personal loan from their bank. About 30% of non-prime do. It's even worse when you get to the basic issue of are products even designed for them. Only 25% of non-prime customers think that bank loan products are even designed for them. Of course, what's sort of interesting is only 50% of prime customers do as well. So there is a disconnect between banks and the emerging needs of consumers in the U.S. And as a result, we've all seen the growth of payday lenders, title lenders, pawn across the country, and banks have pulled back. But this isn't because banks aren't aware of the problem. Banks would love to serve their customers. I met with a president of a large regional bank who said the biggest problem he has is the average credit score of the credit he's originating is 720 to 740. The average credit score of the customer that's opening up checking accounts in the branches, 560 to 580. There's just a huge disconnect, and it's going to take new technologies, new products, to be able to serve the customers that banks aren't able to serve right now. And we currently work with 3 different banks, so we are fully bought into the peanut butter and chocolate synergies that bank fintech relationships can have. And it's not necessarily an easy fit for either side, but the benefits are clearly there. So why is it the banks have pulled back? It's really because serving this customer base is hard. I mean, no two ways about it. Serving a prime customer is pretty easy. Prime is defined by lots of credit history and very little derogatory information. Everybody looks the same. That's why a FICO score looks really great. But in our world, and this is 3 of the different types of archetypes that we tend to look at, you see very different types of customers. You've got that either young or new to the country person like Mariam here, who's a credit invisible. Very hard to serve because you're not going to see really anything on her credit file. Then you go to Jennifer, and of course, how many customers in the U.S. now have gone through some sort of traumatic financial event, whether it be healthcare related or a family situation, maybe an expensive divorce, they went through a bankruptcy, what have you, deeply damaged, maybe they're now using payday loans. That information isn't even reported to the big bureaus, so typically bank lenders don't know about that. And then finally, you've got our customer, Lamont, who we call sort of a overextended prime-ish. He's never used non-prime credit products before, but he had some health problems, and he is heavily overextended. Nobody else will give him traditional forms of credit. So our challenge, and really the challenge of the panelists here, is to try to figure out a way to sort through these customers and figure out how to use new data, how to use new techniques to serve them better. Now, we'll say, the sort of concept of the invisible prime, there's probably 10 new business plans that came out in Silicon Valley in the last 3 hours about serving invisible primes. And the basic business model is the following. There's a woman who just graduated from Harvard with an MBA. She doesn't have any credit history, but she's just about to start a $200,000 a year job. We should find a credit product for her. And there are a few people like that, but that's not the majority of the U.S. I mean, the majority of the U.S. does now have either damaged or limited credit history. They do have income volatility. They have expense volatility. And they are riskier. I mean, no two ways about it. So the first point that we would have is there's no sort of magic to de-risk non-prime lending. You can do a better job of it, but it is still a challenging business, and that's part of why banks are going to need more tools and more techniques to get comfortable serving this customer base. And then finally, we haven't found that there is the magic black box that fixes it all. And we'll talk about what we've done to add on to really, which is, the basic forces. Everybody's using machine learning techniques, everybody's using alternative data sources, but putting them together in a way that both is impactful to the customer and serves the regulatory requirements is not necessarily easy. We're finding our way, and now that we've served 2 million customers, we're starting to get the kind of data to really see the benefits of this. So how do we look at it? Really, this is how we think about the differences between the traditional approaches and what we do. We talked about FICO scores. That is still the majority of how even fintechs serve their customers. we have built more archetype-based scores, as we see, because the difference in trying to understand someone with very little credit information from someone who has deeply damaged traditional credit information to somebody who's sort of on the verge of potentially a financial downward situation, you just can't use the same data, you can't use the same techniques. And we found the best results is when we carve these out separately and think about the deep insights into the customers to drive what we're doing with our scores. Secondarily, and this is sort of almost back to the future, used to be, decades ago, the bankers would tell you, you talk to people, you got a sense of their character and how they operate in the community, you looked at the cash flow in the bank account. Most lenders moved away from that, and they got sort of addicted to the drug of a FICO score. In order to better serve these non-prime consumers, we find you really need to go back to a combination of credit, character, and cash flow, and we'll talk about how you get cash flow and character from these new analytics and new data sources. As everyone's going to talk about, shift from few data sources to a lot of data sources and the complexity around that. And then in our situation, we have to serve customers very rapidly. If we delay their money, they're going to go to a payday lender or an installment lender down the street. So 95% of our customers get an instant decision with no manual review, no documentation. Funds are put into their bank account overnight by ACH or in the UK in minutes. So high levels of automation, low levels of customer friction are essential if you're really going to serve customers that need funds very rapidly. Bank account transaction information, probably the biggest single change in our ability to serve non-prime customers. A couple years ago, we were still slicing and dicing credit bureau information from big bureaus and small bureaus. Now with the access to products that give you a full year of transaction information from the customer's bank account, you can do more things than ever before. And this is probably the most exciting thing that we've been able to see, because now we really can look at things that are more important than historical credit information, but volatility of income, volatility of expenses, some character type traits, like if one customer, when they get paid, takes all their money out of an ATM the next day versus another customer that's putting money into a savings account every month. These are essentially character traits that are very important and are going to start factoring more and more into the ability of lenders to serve non-prime and underserved customers. As Governor Brainerd did a great job explaining some of the challenges we all face from a regulatory perspective, I'll leave you this page, which is our biggest policy issues. And I think if banks are going to serve non-prime customers, they're really going to have to get some regulatory guidance on these three areas in particular. We've all talked about the challenges of providing notices of adverse action. We do it, but it's still a challenge. And oftentimes one wonders, are we just putting a notice of adverse action because it sounds reasonable, or do we really have 100% certainty that the notice of adverse action is really what's driving the score results? Not necessarily that obvious. And of course, you do have, actually, as Governor Brainerd said as well, always concerns about disparate impact as well. So not a trivial solution around that, and I think we're all going to need some help with it. The second is, I mentioned bank account transaction information. Super powerful, the most important thing we're going to have to be able to better serve non-prime customers. But one of the challenges we have is that's a transaction account that may not just be used by the lender that's taking out the credit. So using bank account transaction information, which may be related to the customer's spouse, is not necessarily trivial either. So we've got to start figuring out how we've used that within the regulatory framework. And then finally, similar situation, as I mentioned, reducing customer friction is very, very important for this customer base. So that means less sort of traditional documentation, obviously no face-to-face, and the increased risk around fraud. So for us, a big challenge is using all of these data sources, and we've talked about them, social media footprint, et cetera, to identify potential frauds. But again, then declining around that is not that trivial. It's very hard to say we didn't give you a loan because you don't have a LinkedIn account. So these are all the things we're working through. Because we work with banks, have taken a pretty conservative approach to dealing with all these. But I think if we're going to get the most benefit out of these advanced techniques, these alternate data sources, and really find a way for banks in particular to serve non-prime and underserved customers again, we're all going to need some help around at least these policy issues. So thank you.
All right, what's the trick here?
Don't ask me to help you.
Yeah, right.
There you go.
Okay. I'm a little bit under the weather, so apologies if I'm coughing and hacking. At least I'm the last one on the panel using the podium. We can wipe it down afterwards. My name is Jason Gross. I'm one of the co-founders and the CEO of a company called Petal. We, similar to some of the other models that you've seen today, we work with a bank partner, Web Bank in Utah, to issue a consumer credit card product. Runs on the Visa network. I'm going to use my time today to tell you a little bit about the problem that we're working to solve at Petal, our product specifically and how it works. And then, given the topic of the convening today, I'm going to talk a little bit about our specific underwriting methods, and particularly something that we call cash flow underwriting, which is a technology that we're pioneering to better serve consumers that have thin or no credit information. So first, the problem, sort of the backdrop for which we started Petal. You have 45 million US adults that are unscorable from a credit perspective or credit invisible. And in addition, you have tens of millions of other consumers that have thin credit files, lacking sufficient credit information to generate a representative credit score. In addition, with respect to the new to credit segment, after the financial crisis and the implementation of the Card Act in 2010, we've seen a pretty steep decline in credit card penetration in the 18 to 29 age group. Younger consumers are not beginning to use credit cards at the same age or with the same penetration that they used to. And as a result, folks have shorter credit records. So we see people that are entering the credit system slightly later in life, and it takes quite a while to develop a full credit file. So we see people that are well into their 20s that have depressed credit scores as a result. Of course, you don't show up at the credit bureaus as a 750 FICO score. You kind of start at the bottom and work your way up. The average credit score for folks under the age of 30 is a subprime score. So again, sort of echoing some of the themes that you've already heard, we really have a nation of non-prime consumers. Petal was founded to sort of address this issue. What's interesting about so many of these credit invisible and thin file consumers is that while they lack traditional credit data, they have plenty of other financial information. I saw a statistic the other day that something like 90% of consumer data has been generated over the last 2 years. To give you a sense of all of the information that we're all creating every single day as we conduct our lives. But we focus specifically not on behavioral information or information from social media or something like that. We think that it's prudent to focus first on financial information because there's plenty of financial information that describes these consumers that is not yet factored into mainstream credit decisions. So when you think about Petal and our solution, there's really 3 distinct components of our program. Number one, which I will circle back to and talk about a little bit more, is cash flow underwriting. The automated analysis of the full digital financial record of a consumer. This is taking in not just the record from the credit bureau, but also the digital bank statements of a consumer and the bank account transaction data that is housed therein. This gives us a full picture of a consumer's financial position. I will circle back to that at the end of the presentation, but I want to touch briefly on the other elements of the program as well. So number two, we've focused on designing a credit card product and a digital experience through our mobile application that meets the needs and expectations of consumers that are new to the credit system. So we focused on simplicity, transparency, embedding financial education. If you think about most introductory student or starter credit cards, they rarely come with a financial education component. And a credit card is a fairly complicated financial tool. Even consumers that have used credit cards their entire lives would struggle to explain to you the way that their APR is calculated, when their grace period applies, the variety of different fees that can be imposed on their account. So we've worked really hard to kind of reimagine from the ground up the kind of credit card experience that serves a consumer that is new to the system. And then finally, there's a mission underlying everything that we're doing. We're working to create a new brand in the space that partners with consumers over the long term for their eventual financial success. The technologies that we're talking about significantly reduce the cost to serve this population. And the value that's created from those cost savings and those new efficiencies allow us to provide a superior economic deal to consumers that are using our card. So we're able to offer even folks that are brand new to the credit system with no traditional credit information at all, more credit for less, higher credit limits, lower interest rates, and we do not charge fees. A few slides on our digital product to show you a bit of what I was describing. With a credit card, you're dealing with sort of day-to-day budgeting, spending, cash flow management. We provide a mobile application that makes it easy for folks to track their spending and their budget on a day-to-day, week-to-week basis. We have worked hard to reinvent the payment experience to give consumers more transparency when they're deciding what to pay on their credit card bill. If you think about a typical credit card statement, consumers are presented with two options, the full statement balance and the minimum payment, as if they're two equal choices. And of course, the minimum payment is often, it appears to be a more attractive choice, when really, that is the most expensive choice that a consumer can make in terms of their monthly payment. We instead show consumers the full spectrum of options, and we calculate for them the cost of interest that they will pay over the next month if they make a given payment decision, exposing the true cost associated with carrying a revolving balance. And then finally, it's a fully integrated platform, so consumers can see all of their money in one place, not just a segmented view of here's what you have on your credit card, but you have to open a different app or a different website if you want to see what's going on in your bank account or any of the other financial accounts that you may have. So speaking a little bit about cash flow underwriting, which is really the core technology of our business, we aggregate financial information across financial institutions to compile a full digital financial record of a consumer, which is then analyzed in real time algorithmically. I hesitate to call this approach alternative because I really believe that this is in fact a traditional process using modern technology. So in the underwriting and manual underwriting of a personal loan or a mortgage loan or a small business, oftentimes bank statements are reviewed manually by a human being. We are aggregating bank statements and analyzing them with an algorithm. The average cost to underwrite a mortgage in the United States is something like $8,000, in part because of the amount of manual processing that is involved. Obviously, when dealing with the expansion of credit access, we're talking about small dollar lending products where an $8,000 underwriting process, of course, is not economically feasible. By automating this sort of approach, we can bring the power of all of this additional information to kind of the front lines of access. We work with data aggregators that pull in the information. Consumers permission our access to that information. So a consumer essentially uploads their digital bank statements to our platform. And similar to some of the other folks that you've seen speak today, we're able to tell consumers in a matter of seconds whether or not they pre-qualify without impacting their credit scores. We think about traditional credit information as the liability side of a consumer's balance sheet. But what you don't get from a credit report are the assets or the income statement, the cash flows. And that information speaks directly to a customer's ability to pay and the appropriate price of a product. I think that in terms of policy issues, our number one issue continues to be consumers' ongoing ability to access their own financial information and share that with service providers of their choosing. In the early days of aggregating financial information, it was all about just showing it in one place, just analytics, so the consumer could see all of their accounts in one place. But more and more, we're finding use cases for this data that allow us to expand access and to reduce cost for consumers. So it's terribly important. It is critical to our business, and I think to continued innovation in the space. Thanks.
I know. And I never had to get up. That was great. Thank you very much. I think we can all agree that we were lucky to have some extra time at the beginning because you all did very comprehensive overview of your companies and the ways in which you're using AI. So we want to delve right in with a couple questions. And I think the first is, it's interesting, you all talked prime and subprime, and even within your definition, some people said 700 FICO score, some said 640. So it really is, a changing world because I think, Ken, you even broke it down into 3 subcategories. I think, Jeff, you had some banking desert people and credit invisible. So the world is changing with fintech. Traditional banking looks at it as prime and subprime. Do you think that speak is going away in this world, and where will it evolve to? And particularly how it impacts consumers, because I think in today's world, they look at themselves as prime or subprime with a specific cutoff. So how are we going to help consumers to navigate in this changing environment?
From my perspective, I don't think there really is that much of a good understanding of non-prime customers at this point. Still, there's this sense there's good prime and bad everybody else. And that's what sort of led to banks pulling back and not, I think, investing in understanding the unique needs. So a couple of us have talked about that, it isn't just sort of there's good people and bad people, but there, especially when you get into the less than pristine quality credit, you really have to have some pretty unique insights into those customers' needs, and I think those insights we're going to ultimately help banks both develop better products to serve the needs of the customers, as well as develop the kind of analytics and tools necessary to serve them better. But I don't think there's nearly enough understanding. I think people are still reeling from the recession in a lot of ways and thinking that this is what caused the recession. We have a different perspective on that, but it's going to take a bit more time, I think, and I think academic understanding of what's really happening in the non-prime space.
Yeah, I'll add to that. So I defined it in our presentation as middle income, and we've talked about it a lot, and I think people love to throw around these terms, and as Ken said, subprime, near prime, non-prime. I'm not sure anyone actually has a clear definition of what all of that means. A lot of those definitions are imposed by the capital markets, which a lot of us actually use to fund ourselves. In the Avant platform, loans originated by WebBank that Avant buys. Avant then gets warehouse financing from large banking institutions and then taps the securitization markets. And those markets are used to those monikers. To me, it's cash flow, it's income, and it's your ability to qualify in your performance. And there are consumers that have 580 FICO scores or 600 FICO scores that perform like a 720 or a 750. There are 720 and 750 FICOs that perform like a 580. And it's going to take a little bit of time, but I think those terms are going to go away. And they're embedded in in regulatory frameworks, in bank oversight, in things like the subprime guidance that exists at the FDIC. But really, I think the goal is how do you provide an individual consumer with the appropriate level of credit in the appropriate product for them? And that's what I think a lot of us are trying to do.
I think the other thing that will change, and we're already seeing changing, is the composition and information that informs FICO. So most recently announced that FICO is going to leverage bank account information. Today, it's a prisoner of the same paradigm that we're talking about escaping here. FICO is based, not on a consumer's income or this other information. It's based on credit bureau information. So I don't know if I agree that that definition, subprime, prime will go away. What I think will change, actually, is that FICO will encompass all this data that we've talked about proliferating outside of the credit bureau world. I think that'll be the change, and that it'll be a more defined description of what the consumer is and a fuller picture of what the consumer is.
This one. Yeah, I would maybe pose an alternative view of the future. I don't know where, there are, I think, folks from FICO in the room who could tell you, their specific strategy, where FICO goes in the future and where the bureaus go. But what's interesting about some of these very powerful data sets that we're talking about, digital bank statements, for instance, they're fully in the control of the consumer. When you think about the credit report, while the consumer has rights to access their credit report and to correct errors, the credit report exists outside of the consumer's complete control. It's information that's collected by a third party and then housed in a third-party location. And of course, when you have a lot of sensitive information housed in one place, you can become a target for hackers, as we've seen. I think that in a potential future, consumers will have the information, they'll have the ability to share their information directly with the service provider of their choosing. So the information sits very securely in their bank until the time that they want to do business with a given lender without intermediaries. I think that there's kind of room to reinvent the ecosystem and the structure of how data is shared and accessed and used by the end consumer.
All of you shared in your presentations some of the alternative data sources that you're using. Can you talk a little bit more about those alternative data sources and add on any regulatory perspective, fair lending? I think you had mentioned the notice of adverse action, the impacts to your business. And I'm going to throw another one on too, is you mentioned, I think it was you, Ken, who said turning somebody down for not having a LinkedIn account. So from the consumer perspective, how do we think about, we do a great job now on financial education, helping people understand their credit score. You're opening up, all of you, a whole new world. Like, you don't have a LinkedIn account, you may not get a loan, right? So how do we help consumers to navigate what's going to even become more complex than it already is?
I could just say, at Avant, you don't have to have a LinkedIn account to get a loan, just FYI. I'll add the piece, and I touched on this a little bit. I think historically there's been this view that it's only about a credit decision. And I can't remember who talked about this, but archetypal models and models for specific events. At Avant, we probably have 50 different models that run in the system, talking about whether it's credit or it's fraud or obviously marketing and operations. But I think the distinction between fraud and credit is a very important one that often gets overlooked. And so alternative data today is extremely powerful in fraud decision making, because digital fraud is pervasive. It's a business, it's attractive. And so if in an online transaction, you might see 300, 400 basis points of digital fraud if it's untested, I mean, that's directly proportional to whatever rate you're going to charge a consumer or whether or not you can approve them for a loan. And so we spent a lot of time focused on that fraud aspect. And alternative data is very powerful for that. Credit is more complicated because you have a lot more regulation around credit. And that's where we also are quite conservative around implementing alternative data that might be challenged for fair lending or disparate impact.
Right, I'd agree with that. A lot of the alternate data sources everyone talks about, I mean, my joke about LinkedIn is sort of fraud related, and we really just use that, and I think most people probably do, not so much for a hard decline, but we create more friction for the customer. Now, one of the problems is who's most willing to do whatever friction is necessary? It's the crooks. You know, if you demand a bank statement or an ID scan or something like this, oftentimes the people who've got the time and energy to put all that stuff together are the crooks. So it's not great, and I think from a regulatory perspective, I think there does need to be some policy perspectives on how one uses these alternate data sources in fraud reduction. The big difference for us, as I said, though, has been the advent of bank account transaction information, because that's more true credit type of information. When you can really look at customers, you use the term cash flow, what's the volatility of income over the last year. You can get a sense of life events that have happened and whether they're in a point of instability or a point of stability, and that can really drive the offers that you provide and having much higher levels of affordability. So really interesting information, but again, it is still a bit of a head scratcher how you really put it all together and make sure you're not inadvertently, in particular, having some sort of disparate impact result.
Yeah, I would agree with that, and I would just add that there's a little bit of a sort of definitional challenge here, because alternative data, the best definition I've seen is everything that's not traditional data, right? And so it's sort of a kitchen sink approach, and so we're talking about a lot of different things or potential things that we could look at, all in the same conversation. So, when you start talking about things that are further and further attenuated from the consumer's actual ability to pay, actual financial position, how many friends they have on Facebook or contacts in their cell phone, I think you really do run into some tricky challenges in terms of explaining to a customer why a decision was made with respect to their credit application. But if you're talking about core financial information, bringing it back to cash flow, it actually has quite a bit of sort of precedent and is fairly intuitive for consumers. So if you think about a loan application today, almost invariably consumers report some core financial information, their income, maybe their housing payment, et cetera. Now that information is not always verified and it doesn't always factor into the credit decision. But ability to pay is something that is measured by lenders in the marketplace every single day. I would also add that measures of cash flow really track pretty closely to the consumer's sort of intuitive understanding of their own financial position. So what we're looking at is the consumer's ability to meet their month-to-month financial obligations. Can you pay rent this month and the rest of your bills? How much money do you have in savings, et cetera? And so our experience, at least, in doing cash flow underwriting in the marketplace is that we do not get a lot of confused consumers about these decisions. That there is an intuitive understanding. We like to apply sort of a kitchen table test. If a family's sitting around the kitchen table trying to figure out if they can afford a vacation or afford a new car or something like that, what are they looking at? They're looking at income, they're looking at big upcoming expenses, they're looking at the amount that they have in savings. And if that's what is being analyzed in a credit decision, consumers get it.
Jeff, did you want to add anything, or yep, we covered it? Okay, good.
I think we hit that pretty good.
Okay. So all of your companies were developed post-recession. So what do you think the impact of a recession could have on your losses? And what do you think about, I guess, your current, or can you share a little bit about your risk management strategies at the current time?
Actually, I'll start this off because actually a predecessor product that we had market was through the recession. And what was sort of interesting, we were serving Probably the average FICO score was 580 to 630 with an unsecured installment loan product. And we saw from 2006 to 2011 almost no variation at all in charge-off rates, while credit card charge-offs are tripling over the time. So we actually went to TransUnion and said, are we just unique in this? Are we super good? And everyone else was having more problems. And they actually did analysis that looked at unsecured personal loan portfolios segmented by credit tranche. So super prime versus near prime versus deep subprime. And actually they found volatility of charge-off rates during the recession was let's see, I guess it would be correlated with credit score. The higher your credit score, the higher your volatility. So on normal times, a prime portfolio is going to have lower risk, but you're likely to have it be more negatively impacted by a recession. So we tend to think it's actually a good thing for banks to get back into the business of serving their customers again, in particular non-prime customers in, because it can be recession-proof if done in the right way. Mortgage loans, definitely not the right way. But when we're talking about sort of unsecured personal loan portfolios with relatively short terms, which is what customers tend to want to serve their emergency cash purposes, these can actually be very recession, if not recession resistant, at least less recession influenced than other types of portfolios.
Yeah, we definitely believe that losses will increase, of course, in a recession. The premise of the business when we set it up was to look at the last 5 recessions, and from an average standpoint, unsecured credit in an average recession increases about, charge-off increases about 60%. And the great one was about 270%, as you referenced 3 times. So the game from the beginning has been to build a portfolio that could be resilient, not just in an average recession, but even a great recession. The other thing to understand about the products that most of us are doing is duration is really short and turns really fast. So those are usually the considerations. But definitively, as I sit in front of investors, and I'm sure these guys sit in front of investors, or as you go to the securitization market, there is a question about what's going to happen to losses in a recession, and our expectation is that we may have one again soon, and that when we do, losses go up about 60%.
Jeff, can I just ask you a question on that? Because I wrote this down. You had mentioned in your presentation that you're considering expanding to 7 years. Did I hear? So can you share, I guess, based on what your comments,
Why that's a good idea? Yeah, it was our general counsel. I don't know why he thought it was such a good idea. No, so to your point, we use different terms for different customers. So the 7-year option tends to be for consumers typically that are younger and wealthier and trying to finance a bigger debt load that their income will support. So no, a 7-year term is not a tool that we use for all customers. We've analyzed and think it's appropriate for about 5 to 7% of the customer base that we've got. But no, just because you have a product doesn't mean that you use it for all customers. We try and give them tools that help them find their way forward in managing their debt and their expenses.
Okay.
Yeah, I'll just echo a lot of what Ken and Jeff said. Actually, there was a study from the Philadelphia Fed, and we had aggregated a bunch of information, a la what Ken had talked about, that talked about credit performance through the last couple of cycles, and it's exactly what Ken laid out is if you're in the subprime sector or in the kind of non-prime sector, you're always in some sort of a recession. You have lower incomes that are supplemented better by unemployment insurance. You have less debt load, and if you have very high incomes, you lose your job. It's going to be hard for you to replace that income. Separately from that, there were 2 credit card companies that were profitable through the last recession. It was Capital One and then HSBC because of their household finance credit card portfolio. Again, speaks to the same point. What I think is the more important point is outside of credit is capital, is what happens to the capital markets. Because we all fund ourselves through the capital markets in some way. We're not banks. Today, we don't have deposits. So how do you build a balance sheet, or if you are originating loans that are ultimately sold to investors, and that capital either dries up or becomes more challenged, more expensive, how do you insulate yourself? And I think a recession, if we ever have one, I guess, will test that. And I think the companies that are non-bank lenders that come out of that strongly will build really large businesses over time. And there will be a lot of companies that may not come out of it. But to me, that's the biggest challenge.
I had asked, I guess maybe I got lost in my question, and I'm curious because as a credit counseling organization, traditional banks work with us in terms of helping consumers who are facing financial difficulties. We haven't seen that experience yet with a lot of companies like yours, particularly because they don't have that regulatory profile behind them. So what are your risk management strategies, and how do you anticipate, specifically with consumers, in terms of when they start to experience financial difficulties, how do you work with them?
I'll start. So background similar to some of the folks was in the card space and personal loans. It's very important very early to get in touch with the consumer. The payment typically is much higher than a credit card, where consumers, when they're having some difficulties, can retreat to min pay. And it's really important to get a hold of them right away to see if you can help or work with them. Ways that we work with them are inclusive of, credit consumer counseling, programs that reduce their interest rate or reduce their payment holidays. All those tools are used to help consumers navigate either short-term or long-term issues. But definitively, consumer credit counseling is a tool that we use to work with consumers.
Yeah, I would add one more sort of idea. When we're talking about the differences between cash flow data and traditional credit bureau data, I mean, one of the things that I think the large lenders really struggled with through the recession was sort of the timing, the speed with which financial position of a borrower could deteriorate. And information at the credit bureau is fairly slow to respond to changes. Cash flow information or digital bank information, on the other hand, is nearly real time. And it speaks very strongly to the current financial position of a consumer. So gaps in income, for instance, or extraordinary expenses show up right away. And so, we are working on programs at Petal that leverage that information to intervene earlier. I think that, oftentimes folks don't take advantage of credit counseling and other sorts of programs until they're really in over their head. But there are tipping points that start to emerge earlier. And there are opportunities potentially to help sort of level the ship or correct that trajectory earlier on. And so, we're working on some similar programs to what Jeffrey mentioned, forbearance programs. We offer a network of credit counselors, et cetera.
So, the kind of credit that all of us offer is really lending on the honor principle. We're not taking security. These are online interactions, so it's pretty easy for a lot of customers just to walk away if they want to. And in particular, in our case, dealing with customers that have pretty damaged or no credit scores, there's not a whole lot of downsides for them to do it. It's not like their credit score is going to get worse. So I think like everybody here, and Jeffrey mentioned them, the type of forbearance programs that we all do, we're sort of trying to shift more towards building more of a relationship with their customers around helping them evolve their financial situation, provide some sort of sense of progress in their credit score, progress in their financial health, giving them more frequent notifications of congratulations, things are going up, or by the way, we see that you're starting to face some challenges. Maybe you should reach out and we can talk about helping you get through them. I don't think we are by any stretch of the imagination there yet. We found it actually harder to do than we thought it would be to really build a good connection with the customer around financial health coaching. But ultimately, I think it does get at some of the things you're talking about. If we can be early and often in that customer's life and they look to us as a partner rather than just a lender, I think we have a better chance of working them through whatever financial situation they have, because our customers will, on average, have some sort of financial hiccup along the life of their loan. And obviously, we want to be there through that financial hiccup rather than piling on.
I think that was pretty well covered.
Before we go to the audience, just one final question for me is, you all are working with financial institutions in some capacity. What do you think are the opportunities, and what do you think are the challenges in those relationships?
Maybe I'll jump in since I think it's my turn. So it's a good thing we're all friends here. So Avant's business is the lending business, and we obviously work with WebBank as an origination partner. But a huge part of our business, where I spend a lot of my time, is Amount, which is our technology platform. And specifically, the goal of Amount is to help large banks digitize their credit offerings broadly, starting with personal loans and credit cards and their secured lending through auto, their home equity loan programs. So to me, the biggest opportunity is for banks to really unlock their capability, because banks are very large. They're gigantic institutions that have deep customer relationships. They have millions and millions of customer accounts. To me, the biggest opportunity will be, can they actually digitize their offerings and become digital and become mainstream in their use of technology? And it's hard. It's a challenge. Not all the banks are adapting at the same speed, but we think that's a huge long-term opportunity for consumers.
Okay. I mean, I think we all know. I mentioned that there's a peanut butter and chocolate potential benefit between banks and fintechs working together, but there's also a real oil and water aspect too. I mean, banks work at a different pace than fintech. Everybody knows the fail fast, component of technology. That doesn't work real well with banks. So, we've had to modify our approach quite a bit. I think the banks have had to modify their approach. So, I think, again, it's a very different way of operating, and I think that's a good thing, that ultimately will lead to more sustainable products and less of the sort of noise in other forms of technology that are out there. But it definitely takes, and I think a lot of us have sort of gotten into it, we have to invest in a whole lot more of compliance and regulatory management than most people in the technology world do, for better or for worse.
To your point, for our business, we work very closely and collaboratively with a bank to bring our program to market. And over time, since inception, about a third of our loans have been purchased by banks. And as I look to the future, I actually see fintech and banking just getting closer and closer versus further apart. I think there are huge opportunities to collaborate, and I think there will always be some cultural differences, but there are challenges that both sides have that they together are a strong combination, kind of like the peanut butter and chocolate, that I think will prevail versus the oil and water.
Okay, the audience, I believe there probably are microphones out there. There typically are. And if you could state your name and where you're from.
Yes, hi, Gerald Farner. I work for FICO. So since FICO was mentioned a couple of times, I just wanted to say yes, FICO has a financial inclusion initiative, and we have existing and new products that will take into account consumer-contributed bank data, as well as non-bank data like utility payment, rental payments. And so that makes absolute sense. I would also agree that data is generally more important than AI and machine learning. But I also want to say something in favor of credit bureau data. I think as we're talking about the recession, the next recession coming, there's a big value in credit bureau data because we can go back in the past and see how consumers behaved differently during the last recession and learn from that. And so I would be interested to hear opinions in terms of the newer big data that's only been around for the last 2 years or so. And I think we heard numbers like 90% of the data have been collected only in the last few years. What are the views about, how robust will that data be during the next recession, and when technology change keeps happening at an ever increasing rate?
Thanks. I think it's a great point. And, we've mentioned credit bureau data, FICO scores, and other credit scores so many times because every one of the businesses represented on this panel relies heavily on traditional bureau data. We do as well when it is available on our customers. And I think that, the point is well made that you need a lot of information to be able to build sort of robust credit risk management protocols that can withstand changed economic circumstances. One thing that we've done with respect to consumer bank account data, I mentioned earlier how looking at income and stability in income is actually not a new concept, but something we've been doing for quite a while in a variety of different contexts. When we started Petal, we actually began with an academic study that was done at MIT looking at bank account transaction data through the crisis on a bank's customers, attempting to predict credit default using bank account and card account information rather than bureau information or in addition to bureau information. And like you would imagine, information that describes income and monthly expenses actually does perform pretty well. And as I mentioned earlier, affords you the ability to sort of update your information more frequently because it is so close to real time. So I would again bring it back to core financial information that we understand should serve us well, even in changed economic conditions. If we start talking about more attenuated relationships, social media data, for instance, your guess is as good as mine as to if those predictions will hold in changed economic circumstances. But everything that we're talking about in the world of alternative data really is additive to what we already have. We're moving to a world of multiple data sources that describe different aspects of a borrower's financial life. But it really is a world that is necessary when you see how many people are left out of the mainstream system.
Larry Wall, Federal Reserve Bank of Atlanta. Jason, early in the questions, mentioned the point about consumers owning the data and determining it's being accessed. And certainly the EU and California, with some changes in their laws, have been pushing in that direction. That's all fine given that you have a trained model, because the borrower is incented to share the information with you. But if consumers or even subgroups of consumers start limiting access to data, would that impair your ability to train the models? And if so, where do you think public policy ought to go?
So I think that, first of all, consumer permission and the transparency around consumer permission is paramount. So critically important as we think about designing sort of the proper regime for how this information is transferred, shared, utilized, et cetera. All of the businesses on this panel, we all use our prior experience in lending to get better. One of the one of the primary characteristics of machine learning is that as you get more information, you can improve over time. So I think that the key is being able to disassociate your business information from any consumer personally identifiable information so that we can continue to kind of feed new data into our systems and get better in terms of accuracy. I don't know if others would like to add to that.
Yeah, maybe I'll just add a little bit from a slightly different direction. I had talked about Spring Labs, which was the blockchain company aiming at building the credit ecosystem, ID ecosystem. I think one of the fundamental facets of a decentralized network in that construct is to allow individual consumers to be able to share access and permission access to whatever components of data and information. And the system is ultimately self-correcting, because if consumers restrict access to lots of data, they're going to restrict their own access to credit availability and access to services and products. And so ultimately, I think public policy that shifts towards consumer ownership is positive. And if consumers over time are more focused on accuracy in their broad collection of information, that in turn should actually lead to better access to credit for all of them.
I think, and I'll speak maybe mistakenly on behalf of the group, I don't think any of us would say, the movement from, a European standpoint or a California standpoint is a per se threat. I think the concern people would have at this table, though, is potentially having 50 different sets of rules. And you'd say, how could you ever land on that? Well, we have. So, that 50 sets of different rules isn't just a lose for us, it's a lose for consumers.
So one of the, Shimon Kogan, MIT Sloan. I'm an academic, so I'll preface with that. In the good old world where lenders rely primarily on FICO, it presumably sort of generated more homogeneous decisions, and I don't know if by design, but also helped kind of curve out competition. When data sources and the models become more heterogeneous, are you getting more concerned about adverse selection by consumers? By your face, the answer is no.
Adverse selection, at least in the segment of the population we serve, it's so deeply underserved today. You've got, how many millions of Americans view that their only source of credit is a payday loan store. So I actually think it's sort of the opposite right now. By providing the convenience of Fintech, by providing lower rates, it's sort of, we're getting positive selection because of some of these tools and techniques that we're using.
Thank you. Hi, this is Anna Maria Pacheco. I'm at Moody's Analytics. I would preface, I'm not an academic. I had model validation. So I was just curious to hear your thoughts on consumer consent and the interaction with their understanding of what you're really doing with that data, particularly, like, what are you guys doing with social media data? How does that affect their profile? And in terms of like that adverse selection that we were discussing before, would we get to a point where people would tailor their social footprint to just affect their credit access?
So actually, although we've been talking a little bit about LinkedIn and other social networks, we don't use any social media information, and I don't know if I heard that anyone else at the table does either. And in fact, I think you start running into questions about the FCRA. If you look at the terms and conditions of Facebook, and maybe more people are reading those now these days. But if you do, there's a prohibition against using Facebook data for credit underwriting. And the reason is Facebook doesn't want to potentially fall under the FCRA. So I actually think, a lot has been written about the use of social media data in credit decisioning. I don't think you see it in the marketplace. I can't think of one company in the United States that does that. I think there are examples in other countries, particularly where you have kind of less mature credit infrastructure. But to generalize the point a little bit, the explainability of some of these techniques is very important. And consumers have, I think, today gained a higher level of understanding of the credit score, as Patty pointed out earlier. And I think that all of us are going to have to focus on making very clear to the consumer what they're being asked to share, why, what's being evaluated in a credit decision, and then if that decision comes out in an adverse way, why that decision was made. And that's going to be an ongoing challenge. I mean, I think that when you talk about AI and machine learning, the best methods in this space are methods that are interpretable, that are non-discriminatory, that can be audited and understood. When you start to move to more and more black box decisioning methods, I think that it becomes harder and harder for you to meet those standards in terms of explaining the decision to a consumer.
Great, thanks. Andrew Marquardt, I'm an investor and advisor to banks and fintechs. You guys did a really good job in terms of helping to understand the underserved market and providing credit and credit availability to that market. Though maybe you could expand a little bit more in terms of the invisible prime. How many of those actually are truly prime if you kind of assume that they're all kind of non-prime or near? How many actually are prime based on how, what rates you're charging them, their performance, et cetera? And if they truly are prime, could you also kind of secondarily kind of square that to the other comment about, in a next cycle, how they would actually perform? Thank you. So let me just make one point going back to the adverse selection relative to data from the credit ecosystem versus alternative data. I think in a cycle, what you normally see is you see some sort of a parallel shift in performance. I mean, there's no way you can effectively underwrite a consumer today with 20 years of historical data, because that data is just no longer that relevant. What you can see is what we talked about earlier. In a cycle, our loss is going to go up 25%, 50%, 150%. And so I think you have to look at it in that context. And then back to the idea of kind of how you use data for that invisible prime. It's going to just depend on what that consumer's profile really is. Are they someone that ultimately will become a prime consumer because they're going to have stable cash flow and a high-paying job? They're going to start a business maybe, which today is hard to kind of follow in traditional credit segment, or are they ultimately going to be subprime? And if you can make a judgment call based on that, you could just provide them a credit product today, which otherwise you wouldn't be able to do.
Yeah, I mean, I tend to think that this invisible prime is a small piece of the real need. I mean, the real need is the majority of Americans that are struggling. I mean, we've all seen the news. When you've got half Americans have less than $400 in savings, if you don't have $400 in savings, there's just no way you're a prime. I mean, what you can do a better job, and what I think we're all trying to figure out, is using things like bank account information to understand the periods in that customer's life when they're more prime-like than when they're less, and trying to sort of interact in those stages, and then also sort of tailor the product to the various need. Are they in a downward period? Okay, they may still need some credit. How do we build the credit around that need? Or are they in an upward, more stable period? So that's, I don't know that the old world of sort of you're good or you're bad is I do think an old world, and I think we see more of the in and out, and the challenge is how do you get more temporal in your credit underwriting. That's, again, why I'm such a fan of things like bank account transaction data, as is Jason and others, because it does give you that sort of super precise, super atomized view of exactly where that customer is today and where that customer might be 6 to 12 months out in the future.
I think on this question of recession and the use of credit bureau data or alternative data, is interesting. The difficult thing in a recession that you're trying to predict is unemployment and who's going to lose their job. And credit bureau data doesn't give you any insight into that. That's the hard thing, is your losses are associated with people that lose their job. And I think you probably have a better chance of predicting that with alternative data versus credit bureau data, where it's lagged. It's the timeliness. People fail fast in a recession.
Okay, I think we're out of time. I just want to take a moment, everyone, if you can join me in thanking the panel for their willingness to share.